We want to discuss this chapter of international corporate finance. Let's start with this. I divide the whole chapter into three different parts. In the first two parts, we discuss the different ideas and concepts of this chapter. And in part three, I'm going to solve two questions related to those topics what we discuss in this chapter. So let's start with this one. What are the key concepts we're going to discuss in this chapter? Different terminologies. As the topic of the chapter is reflecting, it's an international corporate finance. The main idea behind this chapter is that if we are operating in different parts of the world and we need finance for our different firms or subsidiaries who are operating in different parts of the world, so uh, uh, the main issue which we have to deal with this is the exchange rate. So the main idea is about exchange rates. And then we also talk about some approaches in trying to finance your operations in overseas through whether you borrow from domestically or provide the finance for doing operation outside country, or whether you have to arrange the finance from outside country. And in the last part of the chapter, we're going to talk about the political implications or political challenges foreign operations of the firms are dealing with. So as I mentioned, the main concepts we're going to different to understand different terminologies. That is important to understand when you are operating in a international environment. Understand how exchange rates are quoted. So that's the second thing I just mentioned, that exchange rates are important to understand when you are operating in different parts of the world where there are different currencies are in use. So what they mean and the difference between spot and forward rates. So exchange rates are quoted in the international exchange market, or when you have to buy or sell your currency in different currencies, then you have to deal with these exchange rates. And exchange rates normally quoted all over the world in a different way, like spot, forward, and there's a cross rate as well. So we want to talk about that. Then that's a little bit economics and finance together, in the sense that we want to talk about purchasing power parity, like that if there is no transportation cost and there is no trade barriers, then the prices of these products are only different in different parts of the world is because of the exchange rate. So that's what we're going to discuss a little bit. And then we also talk about interest rate parity, like the difference in exchange rates, or the future anticipation that that the price of this particular currency will go up or down is dependent on their interest rate in their domestic market, as well as the inflation rate in their domestic market. And when we combine these two things together, there is a very famous economist, Fisher, and that explains about the real rate of interest or the inflation rate we're going to use as well, Fisher effect and their implications for exchange rates. Be able to estimate NPV using the foreign currency or the home currency approach, and know the different types of exchange rate risks and ways the firms manage their risk, like a political risk or a country risk type of things. The impact of a political risk on the international business investment. So let's start. Domestic financial management and international financial management consideration. In international financial management, have to consider the effect of exchange rate when operating in more than one country. So as I mentioned, exchange rate is a very important, like when you are doing operations in different countries. So your reportings in your finances are reported, your financial statements are reported to the parent company or to the headquarter in their own currency. So it is their responsibility to convert it and make it a one statement which is in the currency of the parent company's currency. So that's a very important thing to have to understand. How to consider the political risks associated with the actions of foreign government. So when you are operating in a foreign country, so you are dealing not only with the business, but also you have to deal with their political scenarios, and And definitely we see that the investment, foreign investment, especially goes to those places where there's a political stability, there is a consistencies in their policies, and if the country is facing challenges like war, civil war type of things, or unrest, political unrest, in that type of situation, the foreign investment is not going to be coming in those countries. So more financing opportunities where you consider the international capital market, and this may reduce the firm's cost of capital. So there is a possibility if the firms are operating on such a scale that they can borrow from international banks or international financial institutions, those who are operating all over the world, it is possible that they can get it at a cheaper rate. Now, these are the terminologies we have to use in different perspectives. And the first one here is mentioned as like a cross rate. Now, cross rate is a term we use when the direct rate is uh, one way is like if you look at the exchange rate and go to the any exchange company and you look at their board, the rate is reflected like this: one Canadian dollar is equal to this much US dollar, or vice versa, like one US dollar is equal to that much of a US dollar. And then you have a different currencies like one Canadian dollar is equal to this much yen, one Canadian dollar is this much euro, and on go and so on and so forth. But this is our direct reporting. Now, if we look at the conversion rate, like $1, one Canadian dollar is equal to how much US dollar, and €1 is equal to how much US dollar, and then use this information of these two to figure it out what is the rate of a Canadian dollar in euro terms. That is what we call it as a cross rate. So cross rates are sometimes, if we calculate mathematical by this equation, it can be different from the quoted market rate of $1 is equal to euro. So in that case, there is a possibility of making a profit out of it. But that's again a very technical things that you have to calculate it, and then you have to deal this. Then comes the Eurobond, and Eurobond is a specific type of bond issued is a bond issued in a multiple countries. In a multiple countries means many countries together, all together. Such bonds have become an important way to raise capital for many international companies and governments. Eurobonds are issued outside the restriction and applied to domestic offerings and are syndicate and traded mostly from the London. So trading can be issued in a multiple countries but denominated in a single currency. Like if we want to issue Eurobonds, what does it mean? It means that the Canadian bonds are issued in US, Europe, and in other parts of the world, but the denomination is can be a Canadian dollar, can be a US dollar, can be any other currency. So it's a single currency, it's the same currency issued at different places. That's what we call it as a Eurobond. And why we are emphasizing on this single currency, I will explain you. There's a difference between Eurobond and foreign bonds. So that's the reason. Now, foreign bonds are those bonds which are uh, uh, issued in a single country and are usually denominated in the country's currency. So foreign bonds and euro bonds are different things. Like foreign bonds, if we issue bonds in US in US dollars, so that's called as a foreign bonds. But issued by the any corporation operating in Canada, or any corporation or a government can also issue these types of bonds in other countries as well. So it's harder to understand Eurobond and foreign bonds. Eurocurrency, again, that's in money deposited in the financial centers outside the country. So whatever the money we deposited, like the Bank of Canada has a deposit in New York in US dollar, that is called as a Eurocurrency or a euro. So these are the terms we use in sometimes these currencies also have some different names as well. Export Development Canada, EDC, is an institution. Their main responsibility is to promote exports. They provide loans to the exporters as well, but their job is to provide guidance, training, and also the financing for promoting exports of the country. Gilt is a very specific term used for Great Britain and Irish specific securities, like technically the British and Irish government securities, although the term also includes issues of a local British authorities and some overseas public sector offerings as well. So gilts is not so important, but as it is mentioned in your book, so I uh, uh, the next thing is London Interbank Offer Rate, or simply we call it as a LIBOR. LIBOR, London Interbank Offer Rate, is internationally recognized interest rate of interest among the international banks for borrowing and lending for overnight as well as for a very short period of time. So this is what we call it as a LIBOR. It's because the financial center is in London, so whenever they do these types of transactions, London is a unique characteristics in the financial world. The reason is that London is at a place where they can bridge, they can combine the North America with the Asia. Why? Because London time is such that when the Asia is opening, London's still open. When the Asia is closed, but North America is opening, so London is open. So London is a place where the time is like this, that the Asia is closed, the North America is open. But London has a common bridge between them. That's there is a certain time matching with the North America and the Asia that they can do these transactions. Otherwise, North America and Asia are not matching with that time. So London is providing this facility or to do transactions between the Asia and the North America by this way. So this is the interest rate, overnight interest rate in the financial institutions. But this is also used as a benchmark for various borrowings and lendings. Many large corporations get a lending on a basis of like LIBOR plus one, LIBOR plus two. So they add up the base is LIBOR and add up 1%, 2% depending upon the financial position or situations of the borrowers. But London is considered to be as a prime rate or a benchmark. Swaps are very common in doing this trading business in currencies or in financial instruments. And we see here that interest rate and currency swaps, when two parties exchange in floating rate payment for a fixed payment, that is also a swap, like they are changing the terms of the contract between the floating to the fixed. And currency swaps are agreement to deliver one currency in exchange for another. And we can give a very simple example of a forward contracts for exchange, like for currency. The number of exchanges in foreign countries continues to increase, as does the liquidity of those exchanges. Capital market, the stock markets or the capital market, where the capital instruments are trading, they are increasing day by day, and their operations or volumes are increasing day by day. Some stock markets are very active in the international scenario, or in the international arena. They are very actively participating, like a New York Stock Exchange, NASDAQ. Toronto Stock Exchange is also getting a momentum, and but we can see like a Japanese Nikkei and as well as the Indian Bombay Stock Exchange. So we see that exchange that allows the flow of capital are extremely important for developing a country. So Canada has a very developed capital market, but foreign markets are becoming more competitive and are often willing to try more innovative ways to do business. So we in Canada, the market is a little bit conservative as compared to others. Exchange rate. Now, what is exchange rate? Exchange rate is basically a price we pay for buying a foreign currency. How much we have to pay to buy a $1, how much we have to pay buy a £1 sterling, how much we have to pay to buy a €1. This is the exchange rate, what we can say. So most currencies quoted in terms of US dollar. And we all know that exchange rate, US dollar has a unique characteristics in the world. Like every exchange rate is quoted in terms of how much US dollars you can get it, or how much you have to pay the local currency to get a US dollar. So that is also quoted. Some currencies are quoted the other way around as well. Make sure that you know what is the quote means. Now it's a little bit tricky in the sense that if you are telling us someone that this is the exchange rate between US dollar and Canadian dollar, like 0.70, for example, like 0.70. Now, what does it mean? We have to make it very clear that that $1 US dollar, uh, if you want to buy a one Canadian dollar, you have to pay 0.70 US dollar to buy a one. Now, if the rate is given like this 1.30 or 1.37, 35, then it means that with the one US dollar, you can buy this much of Canadian dollars. So this is a very good table to explain this, what I try to explain you right now. So you see here, this is a spot exchange rate. Spot exchange rate means that immediately you can change the currency at the spot. Now here there's a title mention a US dollar buys, that how much you have to pay in these currencies to buy a one US dollar, to buy a one US dollar. So we see here for Canada, we have to pay a 1.2760 to buy a one US dollar. For euros, we have to pay a 0.9083 to buy a one US dollar. For Japanese yen, we have to pay 123.4306 yen to buy a one US dollar. On this side of the table, this is a Canadian dollar buy. So these are the values of these currencies to pay to get one Canadian dollar. So you pay 0.783 US dollar to get one Canadian dollar. You pay 0.7118 euro to buy a one Canadian dollar. So this is the way that exchanges are quoted. Now, exchanges are also quoted in terms of a forward, like if you set today, if you deal today, but the transaction is going to take place in future. And this future time period can be a 1 month, 3 months, 6 months, 1 year, 2 year, 3 year, 4 year, 5 year. So that can be possible. But what is the happening is here that you do a contract right now, but the actual transaction or actual exchange is going to take place after that. Like for a 1 month period, you say, okay, I'm going to buy after 1 month this much of US dollar. So rate is set right now. It's a 1.2736. So when the time comes or the maturity date of the contract comes, you have to pay this much interest, or whatever the market interest rate is, whatever the market exchange rate is. So if the market exchange rate is worse than this, so maybe you exercise this, but that's something separate. We will talk later, options or forward. But here we just look at this way, like these are the per US dollar, per Canadian dollar, these are the forward rates. Cross rate, as I mentioned, cross rate, we see here, these are the currencies and these are the currencies. So the cross rate is saying that the Canada, we have to pay in 101.2760 to get a $1. Canada, we have to pay 1.4048 to get a $1, 1 euro. Canada, we have to pay 1.9761 to get a pound, franc, peso, yen, and Canadian dollar. So you see in this, in the middle, there is a diagonally, there is no values because the same currency, like Swiss franc to Swiss franc, there is no conversion rate. So there is no way to calculate it, right? So this way is. Now, what I explain you here, what is written. Consider the following code from the table in the previous slide that the Canadian dollar is 1.2760. The first number 1.27 is how many Canadian dollar it takes to buy a one US dollar. You can calculate a second number, which is 0.78, which is a reciprocal of it. So we can also understand that if we want to find out, if we know that one Canadian dollar is equal to this much of US dollar, so we can calculate reciprocal of it, means 1 over that value to get a $1, 1 US dollar is equal to Canadian dollar. Suppose you have a $10,000 based on the rate in our previous slide, and we see that exchange rate is 0.9493 franc per US dollar. and you buy 10,000 US franc, 10,000 using a $10,000 to buy a franc. So by this way, we get it 9,493 francs. Suppose you are visiting New Delhi and want to buy a souvenir that cost you 1,000 Indian rupee. How much it cost in the US dollar? So we multiply this with the exchange rate is 63.4344 rupees per dollar. So these are Indian dollars. So we divided this value with the 63.4344 and we get it like $15.76. So cross rate, as I mentioned, assume that we observe the following quotes like 1.15 Canadian dollars per US dollar and 115 yen per US dollar. So what we want to find out 105 yen per Canadian dollar. So we have a three different rates. One is 1.15 Canadian dollar. 115 per US dollar. So these are against US dollar. And this is the direct quoting of the yen with the Canadian dollar. So if we want to find out the cross rate is going to be helpful in this way, like 115 yen over $1 into 1.15 over $1. So divided by, so by this way, we getting the cross rate is going to be $100. 100 yens is equal to 1 Canadian dollar. But the quoted rate is 105. So we can make a money out of it, as I mentioned. So what we can this since the implied cross rate is 100 per Canadian dollar and the observed cross rate is 105 per. So there is an arbitrage opportunity, and this opportunity, what we call it as an arbitrage opportunity. So we have $100 to invest, buy low, sell high. So what we can do, buy 100 and with the $100 yen, and we get it like 10,500. Use yen to buy US dollar. So we divide by US dollar, which we get it 913041. Use US dollar to convert it into the Canadian dollar, and by this way we get it 105. So you see this triangle arbitrage, like we buy one currency and then convert into the other one and then other one back to the original one. So by this way, we make a $5 income, $5 risk free. So spot trade, exchange rate, currency immediately, the spot rate, the exchange rate for an immediate trade. Forward trade, agreed to exchange currency at some future date and some specified price, also called as a forward contract. And then there is a forward rate, the rate at which the forward contract is going to be signed. So this is the way that definitely that what we are doing is forward premium. If the forward rate is higher than the spot rate, the foreign currency is selling at a premium when quoted as dollar equivalent to. So the Canadian dollar is trading at this spot against the US dollar at this 6 months forward. So since Canadian $1 will buy US dollars in the future, the Canadian dollar is trading at a forward premium because the value is increasing in the forward. Forward discount is also possible, and we see if the forward rate is lower than the spot rate, the foreign currency is selling at a discount. And from the table, we can see that spot against the Canadian dollar is 6 months forward rate. So since US dollar one will buy less Canadian dollar in the future, the US dollar is trading at a forward discount. So both possibles are there. It is not necessarily that every time the forward rate is higher, it can be lower as well. In that case, we see that it's a forward discount. So this is what I want to discuss in this part. So stay tuned. We're going to discuss the second part and also the third one.